Before we begin, a quick and important disclaimer. The information provided in this presentation is strictly for educational and entertainment purposes only and does not constitute professional, legal, tax, or financial advice. The division of retirement assets, specifically 401k accounts, involves highly complex federal regulations, state-specific family court laws, and intricate tax implications. Economic conditions are constantly fluctuating, and historical trends do not indicate future performance. Always consult with a certified qualified domestic relations order specialist, an experienced family law attorney, and a fiduciary financial planner before making any legally binding decisions or signing any documents regarding the division of your marital assets. Imagine it is the height of a roaring bull market. The major indices are hitting record highs every single week, financial headlines are overwhelmingly positive, and consumer confidence is soaring. You are going through the painful and exhausting process of a divorce, and to make things clean, quick, and seemingly simple, you and your soon-to-be ex-spouse agree to split a $1,401,000 portfolio right down the middle. It is a clean 50-50 split, meaning $500,000 goes to each party. To settle the division, you decide to take your half in the high-growth equity funds that have been driving the market surge, convinced you will ride the wave of this massive economic boom straight into an early and comfortable retirement. Your former partner, perhaps more risk-averse or advised differently, takes their share in conservative bond funds, stable value funds, and cash equivalents within their newly segregated account. On the day the judge signs the final decree, it feels entirely equitable on paper. Fast forward 14 months. The economic boom inevitably cools. The Federal Reserve adjusts interest rates to combat the inflation that fueled the expansion. The market undergoes a severe, rapid correction. Those high-growth equity funds you selected plummet by 40%. Your half of that retirement account, which you fought for in mediation, is now worth just $300,000. Meanwhile, your ex-spouse's conservative portfolio remains virtually untouched, shielded from the volatility and quietly yielding steady interest. What looked like a perfect, mathematically flawless 50-50 split during a period of economic euphoria secretly turned into a catastrophic, irreversible wealth transfer. This is the silent, devastating trap of navigating a 401k division when the United States economy is red hot. When asset prices are heavily inflated, logic frequently takes a backseat to emotion and recency bias. People look at soaring account balances and assume that the upward trajectory is a permanent state of reality. We see this in historical trends time and time again. Economic booms consistently mask the fundamental flaws in how couples divide their life savings. During the peak of the dot-com era, during the housing and market surge of the mid-2000s, and during recent post-pandemic rallies, divorcing individuals made critical, life-altering errors by failing to account for market cyclicality. It is not just about the top-line numbers on a monthly brokerage screen. It is about the specific timing of the valuation, the hidden tax landmines embedded within the execution of a qualified domestic relations order, and the dangerous illusion of perpetual growth. Dividing a 401k during an economic boom is fundamentally different than dividing one during a recession. The risk profile is entirely asymmetric. Today, we are going to look at extensive case studies that expose how splitting a retirement account during peak market conditions can financially cripple one spouse while unjustly enriching the other, and how all of this happens entirely within the strict boundaries of family law. If you do not understand the underlying mechanics of what happens to retirement capital when the market is heavily inflated, you are walking into the negotiation room completely blind, vulnerable to mistakes that could delay your retirement by a decade or more. In this comprehensive deep dive masterclass, we are dissecting the exact strategies, historical precedents, and legal frameworks surrounding 401k divorces during periods of intense United States economic expansion. The critical problem you are facing right now, whether you are actively sitting in the middle of a tense mediation, communicating strictly through opposing counsel, or simply preparing for the worst-case scenario, is that current market valuations do not accurately reflect the long-term reality of your retirement survival. A booming economy artificially inflates the perceived value of the equities held within a 401k, making it arguably the most dangerous and deceptive asset to negotiate on a marital balance sheet. We are going to solve the problem of asset illusion. By the end of this presentation, you will understand precisely how to fundamentally evaluate the true, risk-adjusted, and tax-adjusted value of a 401k when the stock market is hovering at an all-time high. We will explore the precise mechanics of a qualified domestic relations order, commonly known as a QDRO. We will explain why executing this specific legal document during a roaring bull market requires a completely different tactical approach and a different set of protective clauses compared to executing one during a bear market. For instance, we will break down the massive difference between defining your division as a fixed dollar amount versus a percentage of the account balance as of the date of segregation. If you agree to a fixed dollar amount during a boom and the market crashes before the QDRO is processed by the plan administrator, a bureaucratic process that can literally take months, one spouse absorbs 100% of the market loss while the other receives their guaranteed fixed cash value. We are going to examine the specific mathematical differences between pre-tax retirement assets and post-tax assets. When the economy is booming, federal and state tax brackets often shift. Legislative changes to capital gains and income taxes become frequent political talking points, and the real purchasing power of the money inside that 401k is constantly being eroded by the inflation that almost always accompanies peak economic expansion. You cannot simply look at a 401k statement balance of $500,000 and treat it like a bank account with $500,000 in liquid cash. You must account for massive deferred tax liabilities, potential early withdrawal penalties, and the broader macroeconomic cycle. We will analyze historical trends to show you exactly how the timing of a QDRO execution changes the entire trajectory of your post-divorce financial life. Furthermore, we will discuss the potential outcomes of offsetting a 401k against an overvalued primary residence. This is a classic textbook mistake made when real estate markets and stock markets peak simultaneously. One spouse keeps the house, the other keeps the 401k, but neither accounts for the fact that the house requires ongoing maintenance, property taxes, and carries distinct illiquidity, while the 401k carries a silent, demanding partner known as the Internal Revenue Service. We will break down step by step how forensic accountants and valuation experts adjust the gross value of retirement assets to strip away the noise of a roaring economy. This provides you with the hard, undeniable court-ready data you need to protect your financial future during negotiations. This masterclass is not about extracting revenge or getting back at an ex-spouse. It is entirely about preserving your financial dignity, maintaining your anticipated standard of living, and ensuring that the wealth you diligently built during the course of your marriage is not accidentally destroyed by the very economic boom you thought would secure your golden years. We are going to meticulously tear down the overwhelming complexities of Federal Employee Retirement Income Security Act laws, contrast state equitable distribution guidelines with community property statutes, and expose the subtle, frequently overlooked nuances of QDRO drafting. We will transform an incredibly overwhelming, anxiety-inducing legal process into a clear, navigable, and highly strategic roadmap. You will learn how to identify the hidden risks in standard settlement templates that attorneys often use out of sheer convenience, and you will discover how to demand specific contractual language that protects your segregated funds from wild market volatility, while the administrative wheels of the financial institution slowly turn. Understanding the deep interplay between a soaring gross domestic product, rising corporate earnings, and your individual divorce settlement is the absolute key to surviving the financial untangling of a marriage during an economic boom. Let us examine exactly how this economic distortion plays out in real time by looking at the current landscape in 2026. The United States stock market has been experiencing intense periods of upward trajectory, fueled by technological advancements, shifting monetary policies, and robust consumer spending. Imagine a couple, Michael and Jessica, living in Illinois. They have been married for 15 years, and over that time, Michael has diligently contributed a portion of his paycheck to his employer-sponsored 401k plan. Because of the prolonged bull market leading up to 2026, that 401k balance has swelled to an impressive $1.2 million. Jessica, who managed the household and supported Michael's career trajectory, is legally entitled to an equitable share of that marital asset under state law. They enter mediation. The mediator looks at the financial statement from the end of the previous quarter, sees the $1.2 million figure, and suggests a straightforward, seemingly fair division. Jessica is allocated $600,000, and Michael retains $600,000. Everyone agrees, believing they have reached a logical resolution based on current, undeniable economic realities. But here is the catastrophic flaw in that specific scenario. A flaw that severely compromises financial futures every single day in the family court system. The legal system moves at a glacial, highly bureaucratic pace, while the financial markets in 2026 move at the blistering speed of algorithmic high-frequency trading. Creating a qualified domestic relations order, the legally mandated document required to split an Employee Retirement Income Security Act governed 401k, is not as simple as writing a standard check or doing an online bank transfer. It is a highly specialized legal mechanism that involves multiple layers of mandatory compliance review. First, an attorney or a specialized drafting firm must meticulously create the QDRO. Then, the opposing counsel must review and approve the drafted language. Once both sides agree on the complex terminology, the document is sent to the 401k plan administrator for preliminary approval. This plan administrator, usually a massive multinational financial institution, can take anywhere from 30 to 90 days just to review the draft and ensure it complies strictly with their specific internal plan guidelines and federal law. If their compliance department finds a single legally ambiguous term or an incorrectly cited statutory code, they reject the document, and the entire timeline resets to day one. Once pre-approved, the document must be submitted to the family court judge for an official signature. After the judge formally signs the order, it goes back to the plan administrator for final execution, which can consume another 30 to 60 days of waiting. We are actively observing a timeline that frequently stretches from 6 to 9 months, and in complex cases over a year, between the date the couple agreed on the financial settlement and the date the financial institution actually moves the capital. Let us apply this extensive timeline to Michael and Jessica during a macroeconomic boom that suddenly encounters a severe, unexpected correction. Suppose their marital settlement agreement explicitly stated that Jessica is to receive a fixed sum of $600,000 from the 401k, based entirely on that initial mediation valuation. While their legal teams and the plan administrator are slowly passing paperwork back and forth, the broader market experiences a violent 15% pullback, which is a completely normal historical trend following a period of irrational economic exuberance. Michael's total 401k balance rapidly drops from $1.2 million to $1,020,000. Finally, the QDRO is processed and executed. Because the legal document legally mandated a fixed cash amount of $600,000, the plan administrator liquidates exactly that specific amount and transfers it to Jessica's newly established rollover individual retirement account. Jessica walks away with her full $600,000, entirely unaffected and completely shielded from the market crash. Michael, conversely, is left holding an empty bag. His remaining balance is not the $600,000 he confidently anticipated during mediation. It is now only $420,000. He involuntarily absorbed 100% of the market loss because of how the static settlement language interacted with the dynamic economic volatility. The booming economy created an intense illusion of permanent stability, causing Michael and his legal team to completely overlook the absolute necessity of drafting the QDRO as a percentage of the account rather than a fixed, unyielding dollar amount. Furthermore, we must closely examine the devastating impact of administrative account freezes during these peak economic periods. When a draft QDRO is officially submitted to a 401k plan administrator, many of these financial institutions impose an immediate, hard administrative freeze on the participant's account. During the year 2026, where we are witnessing rapid market swings based on daily macroeconomic data releases, an administrative freeze means the account owner is completely locked out of executing any defensive trades or reallocating their portfolio. If an economic boom suddenly shows structural signs of cracking, and the participant desperately wishes to move their high-risk equity funds into stable value funds to preserve their core capital, the administrative freeze absolutely prevents them from doing so. They are legally forced to sit on the sidelines and watch their life savings potentially evaporate simply because their divorce paperwork is sitting in a compliance queue. This administrative lockdown is a critical factor that catches almost everyone by surprise. The booming economy makes the asset look incredibly attractive to divide on a spreadsheet, but the actual mechanical process of dividing it systematically strips both spouses of their ability to manage risk precisely when risk management is most urgently required. This directly brings us to the second massive trap of dividing a 401k during an economic expansion, the pre-tax illusion. During a booming economy, wages typically rise, corporate bonuses are generously paid out, and dual-income households frequently find themselves pushed into the highest federal and state marginal tax brackets. When you are looking at a 401k balance, you are looking at a gross, heavily inflated number that has not yet been subjected to taxation by the Internal Revenue Service. If you are the spouse receiving a portion of the 401k, and you decide you need to liquidate a portion of those funds to buy a new primary residence, pay off accumulating legal fees, or simply survive the massive financial transition of a divorce, you are going to face a brutal mathematical reality check. Let us analyze a case study involving a 45-year-old corporate executive named Robert and his spouse Amanda. They legally agreed to split an $800,401,000 portfolio. Amanda receives $400,000 via a properly executed QDRO. Because the economy is booming and local real estate housing prices are aggressively soaring, Amanda decides she must withdraw $100,000 of her awarded share in pure cash to secure a down payment, rather than rolling the entire sum into a tax-advantaged IRA. Because she is executing this specific withdrawal directly through the QDRO mechanism, potential outcomes show she can avoid the standard 10% early withdrawal penalty that usually applies to individuals under the age of 59 and a half. This is a highly specific, often misunderstood provision related to QDRO distributions. However, she absolutely does not avoid ordinary income tax liability. That $100,000 cash withdrawal is added directly to her adjusted gross income for that specific tax year. If the booming economy has already pushed her into a 32% federal tax bracket, and she resides in a state with an 8% income tax, she is immediately surrendering 40% of that withdrawal to various tax authorities. Furthermore, the plan administrator is legally required by federal statute to automatically withhold 20% for federal taxes right off the top before the funds are ever disbursed. Amanda confidently thought she was securing a massive infusion of liquid capital to establish her new independent life, but after mandatory withholdings and massive tax liabilities, her actual purchasing power is drastically and permanently reduced, completely altering her post-divorce financial survival projections. The economic boom deliberately masks these structural deficiencies because the gross numbers look so incredibly large and comforting on official financial statements. Individuals are completely blinded by the sheer size of the inflated asset and consistently fail to calculate the true, after-tax, after-volatility net present value of the capital they are fighting for. You have to aggressively strip away the economic noise and critically analyze the actual mathematical reality of the asset transfer. But identifying these specific traps regarding critical valuation dates, violent market fluctuations, and severe tax implications is only the very first step of the defensive strategy. Once you truly comprehend how an economic boom manipulates the perceived value of your retirement, you are immediately faced with an even more terrifying legal challenge. How do legal professionals effectively force opposing counsel, entrenched mediators, and busy family court judges to acknowledge these hidden systemic risks and actually implement the exact protective clauses required to secure a financial future? What are the specific, non-negotiable legal frameworks that must be forcefully embedded into a settlement agreement to prevent an ex-spouse from unknowingly or maliciously exploiting market volatility, while crucial paperwork is trapped in administrative purgatory? The answer lies in a highly strategic drafting methodology that traditional standard settlement templates completely ignore, and understanding this methodology fundamentally changes the entire balance of power in the negotiation room. To understand this power dynamic, we must first completely deconstruct the extreme danger of boilerplate settlement templates. In the legal profession, time is money. Many attorneys, mediations, and even judges rely on standard, copy and paste settlement language simply to expedite the massive volume of cases moving through the family court system. In a stagnant or entirely predictable economy, these standard templates might arguably suffice. However, in the highly volatile, rapidly expanding economic environment of 2026, relying on a standard template to divide a major retirement asset is the financial equivalent of navigating a minefield blindfolded. These boilerplate agreements almost universally fail to account for the massive time delay between the moment you shake hands on a settlement and the moment the financial institution actually legally transfers the funds. This delay, often spanning 6 to 12 months, is the exact window where an economic boom can either unjustly enrich one spouse or financially devastate the other. The absolute most critical concept you must understand to protect yourself during this vulnerable window is the drafting and strict enforcement of an earnings and losses clause within your qualified domestic relations order. This specific clause is the ultimate equalizer in a booming market. Let us visualize exactly how this works through a detailed case study. Imagine a couple, David and Sarah, going through a divorce in 2026. David is the primary account holder of an employer-sponsored 401k that, due to the current economic expansion, has soared to a valuation of $1.5 million. During mediation, they agreed to a 50-50 split based on the current statement balance, meaning Sarah is entitled to $750,000. If their attorneys use a standard boilerplate template, the agreement will simply state that Sarah receives $750,000 from the account. Now, imagine the legal paperwork takes 8 months to finalize and process through the massive corporate compliance departments. Because we are in the middle of a massive economic boom, the stock market continues to aggressively rally during those exact 8 months. David's 401k portfolio, heavily invested in booming technology and healthcare sectors, grows by an impressive 15%, while the paperwork is sitting on various desks. The total account value swells from $1.5 million to $1.725 million. When the plan administrator finally executes the order, they look strictly at the standard legal text. The text says give Sarah $750,000. They cut a check or initiate a transfer for exactly that amount. But look at what just happened to the massive $225,000 of market growth that occurred during the waiting period. Because there was no specific contractual language addressing market fluctuations, David, simply by being the original account holder, legally absorbs 100% of that economic windfall. Sarah receives absolutely nothing from the historic market rally, even though she was legally entitled to half of the asset that generated those exact returns. The economic boom secretly transferred massive wealth directly into David's pocket simply because of lazy legal drafting. This is precisely why an earnings and losses clause is entirely non-negotiable during a bull market. If Sarah had demanded this specific terminology, the legal document would have dictated that she receives 50% of the account balance as of the date of division, plus or minus all subsequent market earnings and losses up until the exact date of final distribution. With that single, meticulously drafted sentence, the entire financial landscape changes. When the account surges by $225,000 during the 8-month administrative delay, Sarah is legally guaranteed to receive her exact 50% share of that growth. Her final distribution would automatically adjust from $750,000 to $862,500. That is a difference of $112,500 completely saved or completely lost, based entirely on the inclusion of a few specific words in a legal document. Historical trends show that the failure to include an earnings and losses clause is one of the single largest sources of post-divorce financial regret, particularly when the broader United States economy is experiencing immense, rapid growth. But adjusting for numerical value is only half of the battle. We must also rigorously examine the actual physical mechanics of how the asset is transferred, which brings us to the highly strategic concept of in-kind asset transfers. During an economic boom, the absolute last thing you want to do is force the unnecessary liquidation of high-performing assets. When a standard qualified domestic relations order is executed, the default process for many plan administrators is to simply sell off a portion of the mutual funds or target date funds held within the 401k, convert those assets into flat cash, and then transfer that cash to the receiving spouse. This is a terrifyingly risky default mechanism. Imagine if the exact day the plan administrator decides to liquidate the funds, the market experiences a violent, temporary 2-day flash crash, which is a highly common occurrence even in the strongest bull markets as institutional algorithms trigger massive sell-offs. The administrator liquidates your share of the assets at the absolute bottom of that temporary dip, locking in catastrophic losses. A few days later, the market rapidly recovers and continues its upward trajectory, but you are completely locked out of the recovery because your assets have already been converted to cash at the lowest possible valuation point. To completely neutralize this specific risk, sophisticated legal drafting must explicitly demand an in-kind transfer whenever the specific 401k plan rules allow for it. An in-kind transfer means that instead of selling the investments, the plan administrator literally transfers the exact shares of the mutual funds directly from the original 401k into the receiving spouse's newly established rollover account. If the original 401k holds 10,000 shares of an aggressive growth index fund, and you are entitled to half, you receive exactly 5,000 physical shares of that fund, not the cash equivalent. By transferring the actual shares, you completely bypass the risk of being forced to sell on a bad market day. You maintain the exact same market exposure, you preserve the structural integrity of the portfolio, and you retain the absolute total control to decide exactly when, where, and how to eventually liquidate those assets on your own terms, completely independent of the arbitrary administrative timeline of your divorce. Understanding earnings and losses clauses and demanding in-kind transfers are incredibly powerful defensive tactics. They strip away the illusions created by a booming economy and ensure that the mathematical reality of your settlement matches the legal intent of the division. However, all of these advanced drafting strategies operate under one massive glaring assumption. They assume that the $1.5 million account balance you see on the financial statement is actually real, unencumbered money. But what if it is not? What if, under the surface of that massive economic boom, the account holder has secretly deployed a completely legal, entirely hidden financial mechanism to artificially suppress the true value of that 401k right before the divorce was even filed? What if the asset you are so aggressively fighting to divide is secretly drowning in shadow debt that will not appear on a standard balance sheet? To uncover this, we have to expose the dark reality of how 401k loans are weaponized during a United States economic boom, and how failing to audit the internal ledger of the retirement account could leave you entirely responsible for paying off a massive debt you never even knew existed. The concept of a 401k loan is frequently misunderstood, but during a United States economic boom, it becomes a highly weaponized tool in high-stakes divorce litigation. When the stock market is aggressively climbing in 2026, consumer confidence is exceptionally high, and borrowing against a retirement account seems like a low-risk maneuver to the account holder. After all, they are simply borrowing their own money and paying themselves back with interest. However, when a divorce is imminent, this internal borrowing mechanism can be strategically exploited to systematically drain the marital estate right under your nose. To truly comprehend this threat, you must understand the mechanical difference between an outstanding loan balance and a vested account balance, and exactly how financial institutions report these figures on the quarterly statements that your mediator is currently relying on to divide your life savings. Imagine a scenario involving Thomas and Jessica, a couple navigating a complex divorce in the year 2026. Thomas has a 401k through his corporate employer. Because the United States economy has been surging, the gross value of his retirement account has reached $900,000. However, 6 months prior to officially filing for divorce, anticipating the upcoming financial split, Thomas secretly executes a maximum allowable 401k loan of $50,000. He transfers this liquid cash into a separate, undisclosed individual bank account, or perhaps uses it to purchase untraceable physical assets like precious metals or high-end luxury goods. When the divorce proceedings finally begin, Thomas provides Jessica and her legal team with a freshly downloaded 401k statement. The statement prominently displays an account balance of $850,000. The $50,000 is entirely gone from the visible top-line number. If Jessica and her attorney do not conduct rigorous forensic discovery, they will simply agree to divide the $850,000. Jessica walks away with $425,000. Thomas walks away with his $425,000, plus the $50,000 in untraceable liquid cash he maliciously siphoned out before the legal clock started ticking. This is an absolute disaster of financial negligence, and it happens relentlessly in family courts across the country. The economic boom creates a false sense of security. Jessica looks at a massive balance of $850,000 and feels satisfied, completely unaware that the marital estate was intentionally depleted. Furthermore, we must look at the lost opportunity cost of that withdrawal during a bull market. That $50,000 was removed from the market during a period of massive economic expansion. If the mutual funds inside that 401k grew by 20% during the 6 months leading up to the divorce, Thomas did not just hide $50,000 in principal. He destroyed $10,000 in tax-advantaged marital growth. To protect yourself from this devastating trap, your legal counsel must completely reject standard summary statements. You must legally demand the comprehensive transaction history and the complete internal ledger of the 401k for at least 36 to 48 months prior to the date of separation. You are specifically searching for any loan origination documents, amortization schedules, and mysterious cash outflows. If a loan is discovered, the legal strategy must immediately pivot. The gross value of the 401k must be mathematically reconstituted by a forensic accountant. In our scenario, the asset value for the purpose of the divorce settlement is not $850,000. It is the full $900,000, plus potential adjustments for lost market gains. The outstanding $50,000 loan must be aggressively assigned entirely to Thomas' side of the marital balance sheet. This ensures Jessica receives her rightful equitable share, forcing Thomas to absorb the total mathematical impact of his covert borrowing. But the danger of the 401k loan extends far beyond simple asset hiding. There is a massive ticking tax time bomb associated with these loans, and an economic boom significantly accelerates the timer. During periods of rapid economic expansion like 2026, corporate turnover is exceptionally high. Intense job hopping and aggressive corporate headhunting are defining characteristics of a hot labor market. Employees frequently leave their current jobs for massive salary increases at competing firms. Here is the critical problem. If Thomas leaves his corporate employer, either voluntarily for a better job or involuntarily, while he still has an outstanding 401k loan, that loan is immediately accelerated. Under federal regulations, he typically has until the due date of his federal income tax return for that specific year to repay the entire $50,000 balance in full. If he cannot produce $50,000 in liquid cash to repay the plan administrator, the loan completely defaults. When a 401k loan defaults, it is reclassified by the Internal Revenue Service as a deemed taxable distribution. This is a catastrophic financial event. The $50,000 is immediately added to his taxable income for the year. If the booming economy has pushed his household income into a high tax bracket, he will owe massive federal and state income taxes on that phantom money. Furthermore, if he is under the age of 59 and a half, he will be hit with an additional 10% early withdrawal penalty. Why does this matter to Jessica? It matters because if this default occurs before the divorce is completely finalized, or if they are still filing their annual tax returns jointly for that specific year, Jessica could be held jointly and severally liable by the Internal Revenue Service for the massive tax debt generated by Thomas defaulting on a loan she never even authorized or benefited from. The economic boom facilitated the job change triggered the loan default, and the loan default created a massive tax liability that threatens to completely wipe out Jessica post-divorce financial stability. To completely neutralize this catastrophic threat, the Qualified Domestic Relations Order and the underlying marital settlement agreement must contain highly specific, legally binding indemnification clauses. The legal language must explicitly state that any outstanding loans taken by the participant spouse are their sole and separate financial responsibility. Furthermore, it must legally dictate that if the loan defaults and generates a deemed distribution, the participant spouse is 100% legally responsible for any resulting tax liabilities, federal penalties, or interest, and must hold the non-participant spouse completely harmless from the IRS. This is not standard boilerplate language found in cheap legal templates. This requires a dedicated financial litigator who deeply understands the intersection of family law, corporate benefits, and the federal tax code. You cannot rely on a neutral mediator to automatically include these aggressive protections. You must aggressively advocate for them yourself. You must treat the outstanding loan not just as missing marital money, but as an active, volatile liability that could explode at any moment. Protecting yourself from shadow debt and weaponized 401k loans requires immense vigilance, but it is entirely possible once you know exactly what documents to subpoena and what clauses to draft. However, even if you successfully reconstitute the gross account balance and fully indemnify yourself against future tax liabilities, you are still facing an incredibly dangerous blind spot. In a surging economy, massive portions of a 401k are frequently locked behind complex corporate retention mechanisms. You might be fighting tooth and nail over an account balance that does not actually belong to you yet. If you execute your settlement without meticulously analyzing the intricate details of employer matching contributions, specialized profit-sharing allocations, and corporate vesting schedules, you could be unknowingly surrendering hundreds of thousands of dollars directly back to your ex-spouse employer. What happens when the family court judge legally awards you 50% of an account, but the corporate plan administrator looks at the paperwork and formally declares that 30% of those funds are unvested and legally off-limits? The answer to that specific question reveals the single most expensive mistake divorcing couples make during an economic boom, and the exact steps to prevent it are far more complex than anyone realizes. To fully comprehend the sheer magnitude of this specific financial hazard, we must tear back the curtain on how modern corporate compensation structures are intentionally designed during a massive economic boom. In the fiercely competitive labor market of 2026, companies are aggressively fighting to attract and retain top-tier talent. Standard base salaries are no longer sufficient. Instead, corporations are utilizing sophisticated financial retention mechanisms, primarily in the form of massive employer matching contributions and lucrative annual profit-sharing deposits directed straight into employee 401k accounts. However, these massive corporate contributions are rarely given freely or immediately. They are almost universally chained to strict, legally binding vesting schedules. A vesting schedule dictates the exact timeline over which an employee actually assumes legal ownership of the funds their employer has deposited. Until that specific vesting period completely expires, that money does not belong to the employee. It belongs entirely to the corporation, acting as a golden handcuff to prevent the employee from jumping to a competitor. Imagine a highly common scenario unfolding in family courts right now. Christopher and Emily are going through a heavily contested divorce in 2026. Christopher works as a senior director for a rapidly expanding technology firm. Due to the intense economic boom, his company has been incredibly generous, depositing a massive 50% match on all of his 401k contributions, alongside a massive year-end profit-sharing bonus. When Emily and her legal team formally request Christopher's current 401k statement for the mediation process, the financial document proudly displays a gross total account balance of $1.6 million. Emily and her forensic accountant naturally assume this $1.6 million represents the divisible marital estate. They strategically agree to trade away her legal rights to the primary marital residence, which holds $800,000 in pure equity, in exchange for receiving exactly $800,000 from the 401k via a qualified domestic relations order. It looks like a perfectly symmetrical, completely fair separation of assets on the negotiation table. But here is the devastating reality that boilerplate legal templates and hurried mediators completely overlook. The detailed summary plan description, a massive legal document that governs the internal rules of Christopher's 401k, contains a 5-year cliff vesting schedule for all employer matches and profit-sharing contributions. A cliff vesting schedule means the employee has absolutely 0% ownership of those specific corporate funds until the exact day they reach their 5-year work anniversary. Christopher has only been with this specific technology firm for 4 years. Out of that massive $1.6 million balance, $400,000 consists entirely of unvested employer contributions. Christopher does not legally own that $400,000. Therefore, it mathematically cannot be divided as a marital asset. When Emily's legal team submits the officially signed qualified domestic relations order to the massive corporate plan administrator, demanding an $800,000 transfer, the compliance department immediately audits the account. They look at the vested balance, which is only $1.2 million. Because plan administrators are legally bound by stringent Federal Employee Retirement Income Security Act regulations, they cannot and will not distribute unvested funds to a non-participant spouse under any circumstances. Depending on the exact legal phrasing of the poorly drafted order, the plan administrator will either flatly reject the entire legal document, forcing Emily to start the agonizingly slow legal process all over again while incurring massive attorney fees, or they will execute the order based strictly on the vested amount. If they distribute based on the vested amount, Emily's financial future is permanently compromised. She traded away a rock-solid, fully owned real estate asset worth $800,000 for a retirement distribution that might ultimately yield far less than she legally anticipated, all because her legal counsel failed to distinguish between the gross account balance and the legally vested account balance. This trap becomes exponentially more dangerous during an economic boom because of the sheer velocity of the labor market. In 2026, corporate headhunting is aggressive, and employees are constantly transitioning to new roles for massive salary increases. Suppose Emily was legally awarded a percentage of those unvested funds under a complex legal framework called a reserved jurisdiction clause, which essentially dictates that she will receive her designated share of those unvested funds if and when they finally vest in the future. The economic boom completely destabilizes this strategy. 6 months after the divorce is completely finalized, Christopher is poached by a rival software company offering a 30% salary increase. He voluntarily resigns from his current position. The absolute second his resignation is formally processed by Human Resources, because he has not reached his 5-year anniversary, all $400,000 of those unvested employer contributions instantly evaporate. They are legally forfeited and permanently returned to the corporate treasury. Emily's reserved legal right to those future funds becomes entirely worthless in a matter of seconds. She negotiated for phantom assets that relied entirely on her ex-spouse remaining at a specific job, a highly improbable outcome during a period of massive economic mobility. Furthermore, we must rigorously analyze the timing of corporate profit-sharing deposits, which peak during intense economic expansions. Corporations typically finalize their accounting for a highly profitable fiscal year in late December, but they do not physically deposit the profit-sharing funds into employee 401k accounts until March or April of the following year. If your marital settlement agreement is officially signed by a judge in February, utilizing a strict valuation date of February 1st, you are completely locking yourself out of a massive financial windfall that was earned strictly during the marital period. The corporate profits were generated by the employee's hard work during the marriage, but because the physical cash deposit was delayed by corporate accounting schedules, the non-employee spouse completely misses the distribution. The employed spouse quietly receives a massive, undivided deposit into their separate account just weeks after the divorce is finalized. To successfully navigate this corporate labyrinth, you must fundamentally change your legal demands. You cannot simply subpoena the quarterly summary statement. You must legally demand the official summary plan description, the exact mathematical breakdown of the vested versus unvested balances, and the historical timeline of all corporate profit-sharing deposits. Your settlement language must contain highly specific, aggressively drafted look-back clauses that legally capture any delayed corporate deposits based on work performed during the marriage, regardless of when the physical transfer of funds actually occurs. You must treat the vesting schedule not as a minor administrative detail, but as a critical threat to your post-divorce financial survival. Yet, even if you successfully isolate the vested funds and completely protect yourself from delayed profit-sharing distributions, you are about to collide with the most mathematically complex and highly litigated aspect of dividing a retirement account. What happens when the economic boom has drastically inflated funds that were sitting in the 401k long before you even met your spouse? When a decade-long bull market forcefully collides with a long-term marriage, the line between separate premarital property and divisible marital property completely disintegrates. The financial industry and the family court system rely on a highly specific, universally applied mathematical formula to separate these funds, but during a massive economic expansion, this standard mathematical formula contains a hidden, systemic bias that aggressively favors the original account holder and systematically deprives the non-participant spouse of their rightful equitable growth. If you simply accept the court's default calculation without understanding the deep mechanics of passive versus active market appreciation, you are unknowingly forfeiting a massive percentage of your wealth. The standard mathematical formula used by the vast majority of family courts to determine the marital portion of a retirement account is known as the coverture fraction, or in many jurisdictions, the Majorska's formula. In a stable or low-growth economy, this formula is a relatively blunt instrument that functions with acceptable levels of accuracy. However, during a massive United States economic boom like the one we are experiencing in 2026, the coverture fraction becomes a mathematically flawed relic that can lead to a significant misallocation of marital wealth. To understand why, you must understand the formula itself. It is a simple fraction where the numerator is the total months of the marriage during which contributions were made to the 401k, and the denominator is the total number of months the employee has participated in the plan from its inception to the date of the divorce. You then multiply the current, total account balance by this fraction to find the marital portion. Imagine a professional named Mark who started his 401k in 2010. He married Sarah in 2018, and they are now divorcing in 2026. Mark has been in the plan for 16 years, or 192 months. He was married for 8 of those years, or 96 months. According to the coverture fraction, exactly 50% of the total account balance is marital property, regardless of when the actual growth occurred. If the account is worth $1 million today, the court assumes $500,000 was earned during the marriage. But this entirely ignores the reality of the 2026 economic boom. What if Mark had $500,000 in the account on the day he married Sarah in 2018, and because of the massive compounding bull market of the last 8 years, that original separate property grew purely through passive market appreciation to $900,000 without him adding another penny? In this scenario, almost the entire value of the account is Mark's separate, premarital property. Conversely, what if the account was worth almost nothing in 2018, and 90% of the current $1 million balance was generated by aggressive marital contributions and the explosive market rally of 2024 through 2026. In that case, the coverture fraction drastically undercounts Sarah's rightful share. The fatal flaw of the coverture fraction during an economic boom is that it assumes growth is linear. It assumes that wealth is built in a straight, predictable line from day one to the date of divorce. But wealth in a 401k is never linear. It is exponential, especially during a boom. When the market is surging, the compounding effect on contributions made later in the marriage can be far more significant than the slow growth of early years. To combat this, sophisticated legal teams must move away from the coverture fraction and move toward a comprehensive tracing analysis. Tracing involves a forensic accountant rebuilding the account history month by month, separating the growth of the premarital balance from the growth of the marital contributions. In a high-stakes 2026 divorce, failing to perform a tracing analysis is the equivalent of leaving your financial future to a coin flip. Historical trends show that in cases involving high net worth 401ks, the difference between a coverture fraction and a detailed tracing analysis can result in a shift of hundreds of thousands of dollars in the final settlement. This leads us to the critical distinction between passive and active appreciation. Passive appreciation is the growth of an asset due strictly to market forces, such as the overall rise of the S&P 500 during an economic boom. Active appreciation is growth resulting from the direct efforts, contributions, or management of the parties during the marriage. Many states treat passive appreciation on separate property as separate property, while other states classify it as marital. If you live in a state where passive appreciation is separate, and you are the non-participant spouse, an economic boom is your greatest mathematical enemy. Your ex-spouse's attorney will argue that the massive surge in the 401k value over the last 3 years is purely passive growth on the premarital balance and should therefore be excluded from the marital pot. You must be prepared to counter this by demonstrating how marital salary deferrals, corporate matching, and even the strategic reallocation of funds during the marriage converted that growth into an active, marital component. Let us look at a case study involving a character named Linda, a high-level executive with a substantial 401k established long before her marriage to David. During their 10-year marriage, the United States economy experienced 2 major expansionary cycles. Linda's attorney argues that the 401k, which grew from $400,000 to $1.5 million during the marriage, is largely separate property because the underlying index funds simply followed the market's upward trajectory. David's forensic team, however, conducts a deep dive into the transaction logs. They discover that every quarter, Linda and David sat down and rebalanced the portfolio, moving money from stagnant bonds into high-performing tech stocks. They argue that this intentional, strategic management constitutes active marital effort. By successfully reclassifying just 20% of that appreciation as active rather than passive, David potentially secures an additional $100,000 in the settlement. In the year 2026, where market volatility is high and the definition of active management is constantly being litigated, this distinction is where the real financial war is won. Furthermore, we must address the sheer complexity of commingling. During a booming economy, people feel wealthy and often make impulsive financial moves. It is common for an individual to roll over an old 401k from a previous employer into their current 401k plan during the marriage. This is a catastrophic mistake for the person trying to protect separate property. Once those premarital funds are rolled into a marital 401k, and then mixed with new marital contributions and employer matches during a market surge, they become legally commingled. In many jurisdictions, once assets are commingled to the point where they can no longer be clearly identified, the court simply declares the entire account to be marital property. The economic boom exacerbates this because the high volume of transactions and the rapid growth make it even harder to unscramble the eggs. If you are the one with the premarital assets, you need a forensic accountant to perform a painstaking dollar-for-dollar tracing to maintain the separate character of those funds. If you are the spouse looking for a fair share, you are searching for any evidence that the separate identity of those early funds has been lost in the sea of marital activity. As we navigate these complex mathematical formulas and forensic tracing methods, we are essentially trying to capture a snapshot of a moving target. The 2026 economy is not a static environment. It is a living, breathing entity that changes between the morning opening bell and the afternoon close. This brings us to a terrifying question that most people only realize after it is too late. What happens if the economic boom you are relying on to fund your post-divorce life is actually a bubble? If you negotiate your 401k split based on the hyperinflated valuations of a peak market, and that bubble bursts during the months it takes for the QDRO to be processed, you could find yourself legally entitled to a percentage of an account that no longer exists in its previous form. We have discussed the mechanics of drafting, the traps of vesting, and the flaws of coverture fractions, but we have not yet touched on the most psychological and dangerous element of a 401k divorce, the valuation date. The choice of a single day on the calendar can be the difference between a prosperous retirement and a financial catastrophe, and the battle over that date is where the most aggressive legal maneuvering occurs. If you don't know how to lock in your value during a peak, you are at the mercy of the next market correction. The selection of a valuation date is perhaps the most consequential chess move in the entire divorce process, yet it is often treated as a mere administrative formality. In a booming 2026 economy, where the S&P 500 might move 2 or 3% in a single week, the difference between using the date of filing, the date of trial, or the date of the final decree can translate into tens of thousands of dollars. Historically, state laws vary wildly on this. Some jurisdictions mandate the date of filing as the bright line cutoff, while others allow the judge broad discretion to choose a date that is most equitable. During an economic expansion, the account holder almost always pushes for an earlier valuation date to exclude the most recent market gains from the marital pot. Conversely, the non-participant spouse fights for the latest possible date to capture every cent of that upward momentum. Imagine a case involving Marcus and Elena. They file for divorce in January 2026. At the time of filing, Marcus's 401k is valued at $800,000. However, due to a massive surge in the technology sector and positive domestic economic data, the account balloons to $950,000 by the time they reach a final settlement in August. If the court strictly adheres to the date of filing, that $150,000 gain is classified as Marcus's separate property. Elena effectively loses out on $75,000 that was generated by marital capital simply because of a calendar entry. To prevent this, your legal strategy must involve arguing for a valuation date that reflects the functional end of the economic partnership, rather than just the day a clerk stamped a piece of paper. This brings us to the highly technical concept of post-separation contributions versus post-separation appreciation. Even if you agree on a valuation date, you must mathematically distinguish between the growth caused by the market and the growth caused by Marcus continuing to deposit money from his paycheck after the filing. In 2026, many high earners are maximizing their 401k contributions to take advantage of the boom. Marcus might have contributed $20,000 of his own post-separation salary during those 8 months. He is legally entitled to keep 100% of those specific contributions. However, Elena is still entitled to her share of the market appreciation on the marital portion of the balance that existed before the filing. Without a forensic accountant to separate these two distinct growth engines, Marcus's attorney might attempt to sweep all the gains into the separate property category, claiming it was all a result of his post-separation efforts. The stakes of the valuation date are further magnified by the threat of a market bubble. If the 2026 boom is reaching a point of irrational exuberance, being the spouse who receives a fixed dollar amount based on a peak valuation is the most dangerous position you can inhabit. Let us look at a case study of a spouse named Karen. She agrees to a settlement in October 2026, during the absolute height of a market rally. She is awarded $400,000 as a flat fee from her husband's 401k. However, the legal system stalls. A backlog in the family court prevents the judge from signing the QDRO until January 2027. In December 2026, the economic boom hits a structural wall. Interest rates spike, and the market undergoes a sharp 12% correction. Because Karen's settlement specified a fixed dollar amount of $400,000 based on the October peak, and because the account still has enough total value to cover that amount, she still gets her $400,000. Her ex-husband, however, sees his remaining share decimated. He absorbs the entire 12% market drop for the whole account. This is why valuation dates are not just about picking a day. They are about allocating the risk of what happens after that day. To navigate this, sophisticated 2026 settlement agreements are moving toward hybrid valuation models. Instead of one fixed date, the agreement might state that the non-participant spouse receives a specific percentage of the account as of the date of the decree, but with a floor or a ceiling to protect both parties from extreme volatility during the processing period. This ensures that neither party is unintentionally wiped out by a sudden shift in the United States economy, while they are waiting for a plan administrator to press a button. We must also consider the role of the 401k plan's specific valuation frequency. While most modern plans value daily, some older or smaller employer plans only value assets quarterly or even annually. If you are divorcing in a boom and your plan only values once a year, you could be negotiating using data that is 11 months out of date. This discrepancy creates a massive opportunity for arbitrage that an aggressive spouse can exploit. Furthermore, we cannot ignore the psychological warfare inherent in valuation. In a booming economy, the account holder often experiences a sense of ownership that is reinforced by the rising numbers. They feel they are the ones making the money. This often leads to a high-risk behavior known as shadow rebalancing. Imagine Marcus, seeing the divorce is going poorly, decides to move all the high-growth equities in the 401k into a low-interest cash account. He does this because he knows he will have to give half to Elena, and he wants to ensure that the marital portion doesn't grow another cent while the case is pending. He effectively freezes her growth while the rest of the market is soaring. This is often a violation of standing court orders that prohibit the changing of financial assets during a divorce, but it is incredibly difficult to catch unless you are demanding monthly statements during the entire litigation process. If you catch this, you can ask the court for a credit to compensate for the lost opportunity cost of the growth you would have achieved had he not interfered with the investment strategy. The interplay between the legal valuation date and the physical market reality is where the most significant wealth transfers occur in a 2026 divorce. It requires a level of precision that goes far beyond traditional legal training. You are essentially acting as a market timer within a legal framework. But even if you perfectly time the valuation and secure a fair percentage of the boom time gains, you are still left with the most difficult decision of all. What do you actually do with the money once it is in your hands? The 2026 economic boom makes everything look like a winning investment, but the tax rules surrounding QDRO distributions are a labyrinth of unique exceptions and hidden traps. If you take the money out the wrong way, or at the wrong time, the Internal Revenue Service can take a larger bite of your settlement than your ex-spouse ever did. We have analyzed how to get the money, but now we must master the art of keeping it, because the way you handle the transition from a 401k to your own independent accounts will determine your tax liability for years to come. One specific, little-known IRS rule allows for a penalty-free withdrawal during a divorce, but if you miss the narrow window to execute it, you lose that privilege forever. The narrow window we are discussing involves Internal Revenue Code Section 72(t)(2)(c). This specific provision is one of the most powerful yet frequently mismanaged tools in the entire financial arsenal of a divorcing individual. In the high inflation, high-growth environment of 2026, liquidity is often the primary concern for a spouse transitioning to a single-income household. Usually, if you are under the age of 59 and a half, and you withdraw funds from a traditional 401k, you are hit with a 10% early withdrawal penalty in addition to ordinary income taxes. However, when funds are distributed pursuant to a qualified domestic relations order, the 10% penalty is waived for the non-participant spouse. This creates a one-time liquidity event that can be used to pay off high-interest debt, secure a new residence in an expensive housing market, or create an emergency cash reserve. But there is a massive catch that catches thousands of Americans off guard every year. This penalty waiver only applies to the initial distribution coming directly from the employer-sponsored plan. Let us look at a case study involving a character named Sarah. Sarah is 42 years old and is being awarded $200,000 from her ex-husband's 401k in 2026. Her attorney and financial advisor correctly tell her about the QDRO penalty exception. However, Sarah makes the common mistake of having the entire $200,000 rolled over into a new individual retirement account in her own name first, thinking she will take the cash out later once she finds a house. The moment those funds hit her IRA, they are no longer governed by the QDRO rules. They are governed by standard IRA rules. When she attempts to withdraw $50,000 for a down payment 3 months later, she is shocked to find that the 10% penalty has been reinstated. By rolling the money over into an IRA before taking the cash distribution, she effectively locked the door on the penalty-free window and cost herself $5,000 in unnecessary fees. To execute this correctly in 2026, you must instruct the plan administrator to perform a split distribution. Part of the award goes directly to you as a taxable but penalty-free check, and the remainder is rolled over into your IRA to continue growing. The timing of this distribution is critical because of the tax withholding requirements. Federal law mandates that the plan administrator withhold exactly 20% for federal income taxes on any cash distribution paid directly to you. In a booming economy where you might already be in a high tax bracket, that 20% might not even cover your total tax liability. If your effective tax rate is 32%, you will still owe an additional 12% when you file your returns the following year. Imagine Sarah takes $50,000 out to pay for her move. The plan administrator sends her $40,000 and sends $10,000 to the IRS. Sarah spends the $40,000, only to realize next April that she owes several thousand more in taxes because the mandatory withholding was insufficient for her 2026 income level. Without a dedicated tax strategy, the 401k distribution that was supposed to provide a fresh start actually creates a massive tax debt that can derail your financial recovery. This leads us to the concept of tax bracket management during an economic boom. Because the United States economy in 2026 is seeing significant wage growth and high corporate earnings, many divorcing individuals find themselves at the peak of their earning potential. Taking a large cash distribution from a 401k on top of a high salary can push you into a higher marginal tax bracket, meaning every dollar of your settlement is taxed at a steeper rate than you anticipated. Sophisticated financial planners often look for ways to time the QDRO distribution across different tax years. If you receive your distribution in December, you might be better off delaying the cash portion until January to move that income into the next tax year, potentially saving thousands in taxes if you expect your income to be lower post-divorce. Historical trends show that the lack of tax coordination between the legal and financial teams is the primary reason why net settlement amounts often fall short of the projections used during mediation. Furthermore, we must address the strategic use of highly appreciated company stock within a 401k, a scenario that is very common during a 2026 bull market. If the 401k contains shares of the employer's stock that have increased significantly in value, you might be eligible for a specialized tax strategy known as net unrealized appreciation, or NUA. Under NUA rules, you can transfer the company stock out of the 401k and into a regular brokerage account. You pay ordinary income tax only on the original cost basis of the stock, not its current market value. The massive gain, the appreciation, is taxed at the much lower long-term capital gains rate when you eventually sell the shares. In an economic boom where a tech workers' company stock might have grown 500%, the difference between paying a 37% income tax rate and a 20% capital gains rate on those profits is life-changing. If your QDRO drafter doesn't specifically account for the handling of NUA-eligible stock, they could accidentally force a liquidation within the plan, triggering a massive and unnecessary tax bill. We also need to consider the impact of the 2026 economic environment on the valuation of survivor benefits and death contingencies. While you are waiting for the QDRO to be finalized, there is a period of significant risk. If the participant spouse passes away before the QDRO is formally approved by the plan and the court, the non-participant spouse could lose their entire interest in the account unless specific protective language is included in the interim orders. In a booming economy, the value of these survivor benefits is at an all-time high. Your legal team must ensure that you are designated as the surviving spouse for the purposes of the plan until the exact moment the account is successfully segregated. This is often overlooked in the rush to divide the main balance, but in the world of ERISA-governed plans, a missing survivor benefit clause can result in a total loss of the asset if tragedy strikes during the litigation process. As we move deeper into the technical execution of the division, we encounter the reality of plan-specific fees and administrative costs. During an economic boom, financial institutions often update their fee structures. Dividing a 401k is not free. Plan administrators often charge a QDRO review fee that can range from $500 to several $1,000s. While this seems small compared to $1 million balance, the question of who pays that fee can become a point of contention. Should it be split 50-50? Should it be deducted from the participant's remaining share? Or should it be taken off the top before the division? In 2026, where every penny is being tracked by forensic accountants, these administrative leakage points can add up. The strategic transition of 401k assets is about more than just avoiding penalties. It is about positioning yourself for the next phase of the economic cycle. By the time you reach this stage of the masterclass, you have learned how to value the asset, how to protect it from market swings, and how to navigate the tax traps. But there is one final overarching danger that threatens even the most perfectly executed QDRO. It is the danger of the hidden secondary assets that often hide inside or alongside a corporate 401k plan. In 2026, high earners often have supplemental executive retirement plans, non-qualified deferred compensation, and shadow accounts that don't follow standard 401k rules. If you think your work is done because you secured half of the 401k, you might be leaving 70% of the total retirement wealth on the table without even knowing it exists. How do you find these ghost accounts, and more importantly, how do you force a corporation to divide an asset that isn't even legally required to follow a QDRO? The world of non-qualified plans is the ultimate frontier of divorce financial planning, and it is where the biggest fortunes are won or lost. The 2026 economic boom has created a massive wealth gap between standard employee-sponsored 401k plans and the highly exclusive world of non-qualified deferred compensation plans, often referred to as NQDC or shadow accounts. For a high-earning executive in the United States today, the 401k is often just a small fraction of their total retirement portfolio. Because the IRS limits annual contributions to a 401k, corporations attract top-tier talent by offering these non-qualified plans that allow executives to defer a massive portion of their salary and bonuses without any upper limit. Here is the terrifying reality for a spouse navigating a divorce. While a 401k is governed by the Employee Retirement Income Security Act and is legally required to be divisible via a qualified domestic relations order, non-qualified plans are not. They are essentially unsecured promises from the employer to the employee. They are not held in a separate trust account for the benefit of the employee. Instead, they are part of the general assets of the corporation. This means a QDRO has zero legal authority over an NQDC plan. Imagine a scenario involving an executive named Jonathan and his spouse, Rebecca. They are dividing their assets in 2026. Jonathan has a visible 401k with a balance of $500,000. Rebecca's legal team sees this and focuses all their energy on drafting a perfect QDRO to secure her $250,000 share. However, because Jonathan is a senior vice president at a booming tech firm, he also has a non-qualified deferred compensation account that has accumulated $3 million over the last decade of economic expansion. Because this account does not appear on a standard 401k statement and is not subject to a QDRO, it is incredibly easy for Jonathan to simply omit it from his initial financial disclosures. If Rebecca's attorney does not specifically ask for the corporate plan documents for executive benefits, this $3 million asset remains entirely invisible. Even if it is discovered, the corporation will flatly refuse to process a QDRO for it. They will state that their plan does not allow for the segregation of accounts for an ex-spouse. In this situation, you are forced to use a different legal mechanism known as the if, as, and when distribution or a constructive trust. Instead of the money being moved into Rebecca's own name, the court orders Jonathan to pay Rebecca her share of the funds at the exact moment he eventually receives them from the company. This creates a decade-long financial tie to an ex-spouse that is fraught with risk. If the corporation goes bankrupt during an economic downturn, Jonathan is just another unsecured creditor, and Rebecca's share of that $3 million could evaporate instantly. Furthermore, because these payments are usually taxed as ordinary income to the employee, Rebecca and Jonathan must negotiate a complex tax-sharing agreement to ensure she isn't paying taxes on money she never received, or that Jonathan isn't stuck with the tax bill for her share of the distribution. Historical trends in 2026 show that the miscalculation of tax liabilities on non-qualified plans is a leading cause of post-divorce litigation among high-net-worth couples. We must also look at the strategic use of supplemental executive retirement plans, or SERPs. Unlike a 401k, which is a defined contribution plan where the value is based on the account balance, a SERP is often a defined benefit plan that provides a monthly lifetime payment upon retirement. During a booming economy, the present value of a future monthly payment can be difficult to calculate. Actuaries must use specific discount rates to determine how much a future stream of income is worth in today's dollars. In 2026, where interest rates and inflation are highly volatile, the choice of a discount rate can change the valuation of a SERP by hundreds of thousands of dollars. If the discount rate is too high, the present value looks small, and the employee spouse can buy out the other spouse for a fraction of the actual worth. If the rate is too low, the value looks massive. You cannot simply accept the company's internal valuation. You must hire an independent actuary to perform a competing valuation based on current United States economic data. Another hidden asset class that thrives during economic booms is the restricted stock unit, or RSU, and its cousin, the performance stock unit. While these are not technically 401k assets, they are often integrated into the same retirement planning conversations. In 2026, many executives receive more compensation in the form of stock units than in cash. These units typically vest over a 4-year period. If a divorce occurs when a massive block of stock units has been granted but not yet vested, the question of marital versus separate property becomes a battleground. The court often applies the Nelson formula or the Dietrich formula to determine what percentage of those future shares belongs to the marriage. This calculation is based on the period of time between the date of the grant and the date of separation, versus the date of the grant and the date of vesting. If you are the spouse of an executive, you must ensure that your settlement agreement includes a specific provision for the distribution of these shares as they vest, including a mechanism for covering the massive tax withholding that occurs the moment the shares hit the account. The 2026 economic boom has also seen a surge in the use of cash balance plans. These are hybrid plans that look like a 401k but are legally defined as pension plans. They are highly popular among small business owners, doctors, and partners in law firms because they allow for massive tax-deductible contributions far exceeding 401k limits. The trap with cash balance plans during a divorce is that the account balance shown on a statement is often not the actual value you are entitled to. Because it is a defined benefit plan, the law requires the plan to offer a lump sum payment that is calculated using specific IRS interest rates. During an economic boom, these interest rates can fluctuate wildly. If you are entitled to half of a cash balance plan, the statement might say $500,000, but the actual lump sum value could be $600,000 or $400,000 depending on the current rate environment. Failing to request the official actuarial valuation of a cash balance plan is a common error that leads to a significant misallocation of marital property. As we dissect these secondary and tertiary retirement vehicles, the level of forensic detail required becomes overwhelming for the average person. You are no longer just looking at a 401k. You are auditing a complex web of corporate promises, stock grants, and actuarial projections. The 2026 economy rewards those who understand the fine print and punishes those who rely on the top-line numbers. We have moved from simple account splits to complex wealth transfer strategies involving construction trusts and tax offsetting. But even with all this knowledge, even with the best forensic accountants and the most aggressive QDRO drafters, there is one final piece of the puzzle that can render all your hard work useless. It is the human element, the specific ways an embittered spouse can legally sabotage the 401k assets through investment mismanagement, excessive administrative delays, or strategic job changes during the final months of the divorce. If you don't have a specific set of temporary restraining orders and account monitoring protocols in place, you could be winning the legal war while losing the financial one. The final stage of this masterclass is about the endgame. The final 30 days of the divorce and the exact checklist you must execute to ensure the money actually arrives in your account safely. And what to do if the economic boom suddenly turns into a crash the day before your papers are signed. The final 30 days before your divorce decree is signed represent the most high-risk period of the entire negotiation, particularly during the economic landscape of 2026. In a booming market, the temptation for the participant spouse to engage in strategic mismanagement or subtle asset depletion is at its peak. To counter this, you must implement a rigorous account monitoring protocol that goes far beyond simply waiting for the judge to sign the paperwork. You must realize that until the qualified domestic relations order is officially accepted and executed by the plan administrator, your ex-spouse still maintains total control over the investment allocations within that 401k. They can, with a few clicks, move the entire portfolio into high-risk leveraged ETFs or, conversely, dump everything into a low-yield cash settlement fund during a massive market rally. Imagine a scenario involving a spouse named Brian and his wife, Kimberly. They have reached a settlement in May 2026, agreeing to a 60-40 split of a $2,401,000 in Kimberly's favor. While the attorneys are finalizing the language of the QDRO, the United States economy is experiencing a massive short-term surge in the energy sector. Brian, feeling that he has been treated unfairly in the settlement, decides to gamble with the account. He reallocates the entire balance into speculative green energy startups. If those stocks plummet during the 3 weeks it takes to get the judge's signature, the $2 million balance could drop to $1.4 million. Because the settlement was written as a percentage of the account at the time of distribution, Kimberly's 60% is now 60% of a much smaller number. She loses hundreds of thousands of dollars because there was no mutual agreement or court order freezing the investment allocation during the pendency of the QDRO processing. To prevent this, your final checklist must include the demand for an investment stay. This is a specific legal provision, often part of the temporary restraining orders issued at the start of a divorce but frequently ignored at the end, which prohibits any changes to the underlying investment holdings without written consent from both parties. You must also demand a final, certified statement from the plan administrator exactly 48 hours before the final hearing. This ensures that the numbers being used in the final decree are the most accurate reflection of reality in a fast-moving 2026 market. If you rely on a statement that is even 30 days old, you are negotiating with ghost numbers. Furthermore, we must address the critical danger of the plan administrator's rejection. Even the most meticulously drafted QDRO can be rejected for minor technicalities, such as an outdated plan name or a missing social security number. If the rejection happens after the divorce is finalized and your attorney has closed your file, you are left in a legal limbo. Historical trends suggest that nearly 25% of QDROs are rejected on the first submission. To mitigate this risk, you must insist on a pre-approval letter from the 401k plan's legal department before the judge signs the final order. Most large-scale 401k administrators in the United States offer a pre-approval service where they review the draft and certify that it meets all plan requirements. This step is the single most effective way to ensure the money actually arrives in your account, without a multi-month bureaucratic nightmare. Now, consider the worst-case macroeconomic scenario. The economic boom turns into a sudden crash the day before your papers are signed. In 2026, market corrections can be swift and violent. If your settlement was built on the assumption of a $2 million valuation, and the market drops 10% overnight, the entire logic of your asset division might collapse. For instance, if you were trading away your interest in the marital home for a larger share of the 401k, a market crash makes that trade significantly less attractive. This is why sophisticated agreements include a walk-away provision or a material change clause. This allows either party to return to the negotiating table if the value of a major marital asset fluctuates by more than a specific percentage, usually 5 to 10%, between the date of the agreement and the date of the final decree. This protects you from being legally forced into a settlement that is no longer equitable due to external economic forces. The transition of the funds is the final hurdle. Once the QDRO is approved and the plan administrator is ready to distribute, you must have your own receiving account fully established and ready to accept the wire transfer. In 2026, you have several potential outcomes depending on where you move the money. If you move it to a traditional IRA, you maintain the tax-deferred status and have a wider range of investment options than the original 401k provided. However, if you are looking to hedge against a cooling economy, you might consider moving the funds into a more conservative allocation immediately upon receipt. The moment the money hits your account, you are no longer a passenger in your ex-spouse's retirement plan. You are the captain of your own financial ship. You must have a post-divorce investment plan ready to execute on day one. Let us look at a final case study of a woman named Maria, who successfully navigated this endgame. Maria didn't just wait for her check. She stayed in constant contact with the QDRO drafter, she verified the pre-approval with the plan administrator, and she had her own financial advisor on standby. When the transfer finally occurred during a period of intense market volatility, she was able to immediately move her $400,000 award into a diversified portfolio that protected her from the sector-specific crash that occurred just weeks later. Because she understood the difference between a percentage-based award and a fixed dollar award, and because she accounted for the tax withholding on the small portion she took in cash for her legal fees, she emerged from the divorce with exactly the amount of capital she needed to maintain her lifestyle. This deep dive has covered everything from the initial valuation traps of a booming economy to the hidden dangers of non-vested employer matches, the complexities of non-qualified plans, and the strategic importance of the valuation date. You now possess the knowledge to look past the inflated numbers of a 2026 economic expansion and see the underlying structural risks. You understand that a 401k is not just a bank account. It is a complex legal and tax instrument that requires a specialized approach during a divorce. You have the tools to audit the ledger, identify shadow debt, and demand the protective clauses that the average attorney might overlook. But as one chapter closes, another begins. While the 401k is often the largest liquid asset, it is rarely the only one. In a booming economy, the marital home often carries as much emotional and financial weight as the retirement account. The strategies for dividing a primary residence when interest rates are fluctuating and property values are at an all-time high are equally complex and even more fraught with long-term risk. In the next phase of our masterclass series, we will pivot from the world of retirement accounts to the high-stakes reality of the 2026 real estate market. We will expose how the equity in your home is being manipulated by the same economic boom that inflated your 401k. And we will reveal the secret formulas for calculating the true value of a house when you are being forced to buy out a spouse in a peak market. The transition from retirement security to housing stability is where the final battle for your financial independence will be fought, and the mistakes made there can be just as permanent as a poorly drafted QDRO.